If you're holding silver right now, or if you've been watching from the sidelines waiting for the right moment to enter, what I'm about to share with you could fundamentally change how you approach this market over the next 12 to 18 months. This isn't about predicting where silver will be next week or next month. This is about understanding something far more important: the pattern that's unfolding right now, the mistakes that typically destroy wealth during periods like this, and the decisions you need to make before the window closes. I've watched this cycle repeat itself multiple times over the past 2 decades. And every single time, the same type of investor gets hurt. Not because they chose the wrong asset, but because they misunderstood the nature of the game they were playing. Right now, we're at a critical juncture. The signals are present, the conditions are forming, and the vast majority of small silver investors are positioning themselves in exactly the wrong way. You see, the challenge with precious metals isn't just about understanding supply and demand. It's about understanding yourself, your psychology, your emotional triggers, your capacity to hold through uncertainty. And here's what concerns me most. I'm seeing the same behavioral patterns emerge that I witnessed before previous major turning points. The same overconfidence, the same dismissal of risk, the same assumption that the current trend will continue indefinitely. So today, I'm going to walk you through exactly what's happening in the silver market right now. We'll examine the macro forces at play. We'll look at historical precedent. We'll discuss what existing holders should be thinking about. We'll explore what potential investors need to understand. And critically, we'll identify the specific mistakes that could cost you dearly. This is your warning, not to scare you, but to prepare you. Let's begin. To understand where we are, we first need to understand what silver actually is within the context of financial markets. Silver occupies a unique position. It's both an industrial metal and a monetary metal. This dual nature creates dynamics that don't exist in pure industrial commodities or pure monetary stores of value like gold. Roughly half of silver demand comes from industrial applications: electronics, solar panels, medical equipment, water purification. These are uses that respond to economic activity, to technological trends, to industrial cycles. The other portion of demand comes from investment and monetary purposes: coins, bars, exchange-traded products. This demand responds to entirely different forces: monetary policy, inflation expectations, currency stability, geopolitical uncertainty. This split personality means silver can behave very differently depending on which force is dominant at any given moment. Right now, we're seeing something interesting. Industrial demand remains relatively robust, supported by secular trends in green energy and technology. But it's the monetary demand side that's creating the most significant dynamics. Let me explain what I mean by walking through the current macroeconomic environment. We're living through a period of significant monetary uncertainty. Central banks globally have engaged in unprecedented expansion of money supplies over the past 15 years. Interest rates, while elevated from recent lows, remain historically accommodative in real terms when you account for actual inflation. Government debt levels across developed economies have reached levels that would have been unthinkable 2 decades ago. The United States alone is carrying debt to GDP ratios that historically have been associated with wartime periods or economic crises. This creates what I call the monetary anxiety trade. Investors begin questioning the long-term stability of fiat currencies. They look for alternatives. They seek stores of value that exist outside the traditional financial system. Gold typically captures this narrative first. Silver follows, often with greater volatility due to its smaller market size and split industrial monetary nature. And this is where we need to examine investor psychology, because this is where most people get themselves into trouble. When silver begins to move, it tends to attract a particular type of investor. Someone who missed the early stages of the gold move, someone looking for leverage on the precious metals thesis, someone who's heard that silver is undervalued relative to gold. These investors pile in, price rises, momentum builds, and critically, conviction strengthens. This is the dangerous phase, because conviction based on price movement rather than fundamental understanding creates fragility. Let me share some historical context that illustrates this pattern. In 1980, silver reached nearly $50 per ounce. The Hunt brothers, along with a wave of speculative interest, drove prices to unsustainable levels based on a combination of inflation fears and market manipulation. The subsequent collapse was devastating. Silver didn't return to those nominal highs for 31 years. In 2011, silver again approached $50. This time the driver was quantitative easing, sovereign debt concerns, and fear of monetary debasement following the 2008 financial crisis. Investors convinced themselves that industrial demand plus monetary anxiety created an unstoppable force. The collapse from those levels was swift and brutal. Silver lost nearly 70% of its value over the following years. What's the lesson here? It's not that silver is a bad asset. It's that silver, like all assets, moves in cycles. And the most dangerous moment in any cycle is when participants become convinced that this time is different. Now, let's examine where we are today. Silver has experienced significant appreciation over the past several years. Much of this move has been rational, responding to legitimate macroeconomic concerns and supply-demand fundamentals. But we're now entering a phase where psychology is starting to dominate. I'm seeing increasing numbers of new investors entering the market. Search interest is rising. Social media discussions are becoming more frequent. And critically, the narrative is shifting from cautious accumulation to aggressive speculation. This doesn't mean a top is imminent. Markets can remain elevated far longer than rational analysis would suggest. But it does mean that risk is building. The challenge with silver specifically is its volatility. Because the market is relatively small compared to other asset classes, price movements can be exaggerated in both directions. A wave of buying can push prices up rapidly. A wave of selling can collapse them just as quickly. And here's what most small investors fail to appreciate. Liquidity in precious metals is not symmetric. When you want to buy, there's generally a seller willing to accommodate you at a reasonable spread. But when you want to sell, particularly during a panic, the spread can widen dramatically. The buyer who was there yesterday may disappear. The premium you paid might evaporate. This asymmetry means that your entry point matters enormously, not just in terms of the nominal price, but in terms of where we are in the psychological cycle. Let me be direct about what I'm observing in the current market structure. Premiums on physical silver products have become elevated. This indicates strong retail demand, but it also indicates that the market is already pricing in significant future appreciation. When premiums are high, you're paying not just for the metal, but for the optimism of other buyers. Options activity in silver futures has increased substantially. This is often a sign of speculative interest, rather than hedging or investment interest. Speculators use options to gain leveraged exposure. This amplifies volatility and creates conditions for rapid reversals. The ratio of paper silver claims to physical silver available for delivery has reached levels that suggest the market is becoming structurally unstable. Now, whether this leads to a squeeze or a collapse depends entirely on how the next wave of liquidity moves flow through the system. And this brings us to the critical point that most investors completely miss. The question isn't whether silver will be higher or lower in the future. The question is whether you can maintain your position through the volatility required to get there. Think about this carefully. If you buy silver today and it drops 25% over the next 3 months, what will you do? Will you hold? Will you sell? Will you buy more? Your answer to this question reveals everything about whether you're positioned appropriately. Because here's the reality. Precious metals don't move in straight lines. They trend over years and decades, but they punish impatience over weeks and months. The investors who succeed in this space are the ones who accumulate during periods of apathy, hold through periods of volatility, and reduce exposure during periods of euphoria. The investors who fail are the ones who chase momentum, panic during corrections, and allow emotion to override strategy. So as we move forward, you need to ask yourself a fundamental question. Which type of investor are you? Now let's get specific about what this means for your particular situation. Because the appropriate strategy depends entirely on where you currently stand. Your primary concern right now should be protecting the gains you've already achieved. Notice, I didn't say maximizing gains. I said protecting what you have. This distinction is critical. The temptation when you're sitting on profits is to imagine how much more you could make if the trend continues. This is exactly the psychological trap that destroys wealth. Professional investors think differently. They think about risk-adjusted returns. They think about position sizing. They think about what they can afford to lose versus what they hope to gain. Here's a framework I want you to consider. The concept of scaling. If you accumulated silver when it was significantly lower, you now have embedded gains that represent real wealth transfer. That wealth is only theoretical until you actually realize it. The longer you wait to realize any of it, the more you're betting that the current trend continues without significant interruption. This doesn't mean you should liquidate everything, but it does mean you should be thinking about taking some profits off the table, particularly if your position has grown to represent a disproportionate percentage of your total assets. A reasonable approach might be to reduce your position by 20 to 30%, locking in gains and holding the remainder for continued exposure. This allows you to participate in further upside while reducing your overall risk profile. The freed up capital can be rotated into other uncorrelated assets, improving your portfolio diversification and reducing your dependence on a single narrative playing out. But here's what you absolutely cannot do. You cannot convince yourself that you'll sell when the time is right without defining what that actually means. The time will never feel right. When prices are rising, you'll want to hold for more gains. When prices are falling, you'll want to wait for recovery. You need predetermined rules. If silver reaches a certain level, you reduce by a certain percentage. If it falls to a certain level, you consider adding, or you accept the loss and move on. Remove emotion from the equation by making the decision now, before your judgment is clouded by fear or greed. Another critical consideration for existing holders: storage and security. If you're holding physical metal, is it properly secured? Is it insured? Is your family aware of its existence and location? These practical considerations become increasingly important as values rise. If you're holding paper silver through ETFs or mining stocks, do you understand the counterparty risk you're taking? Do you understand that your claim on silver is different from actual possession of silver? These aren't trivial questions. They're fundamental to whether you'll actually be able to realize the value you believe you have when the time comes. Your challenge is entirely different. You're looking at current prices and trying to determine whether this represents opportunity or danger. The honest answer is it could be either, and there's no way to know with certainty in advance. What you can control is how you enter, how much you allocate, and what expectations you hold. First, let me address the most common mistake potential investors make: waiting for the perfect entry point. You'll convince yourself that you'll buy when there's a pullback. But when the pullback comes, you'll question whether it's enough of a pullback or whether it will go lower. Then when it reverses, you'll wish you'd bought the pullback. This cycle of paralysis prevents action indefinitely. The alternative is dollar cost averaging. Rather than trying to time a single perfect entry, you commit to buying a fixed dollar amount on a regular schedule over an extended period. This averages out your entry price and removes the psychological burden of timing. If you allocate, say, $500 per month to silver purchases over 12 months, you'll end up with a blended entry price that reflects the full range of the market's movement during that period. Some months, you'll buy high. Some months, you'll buy low. Over time, you'll achieve a reasonable average. This approach has another benefit. It forces discipline and prevents overallocation. Which brings me to position sizing. This is perhaps the most critical decision you'll make. Precious metals should represent portfolio diversification, not portfolio concentration. A reasonable allocation for most investors is somewhere between 5 and 15% of total investable assets. Not 50%, not 75%, not 100%. I understand the temptation. You've read the compelling narratives about currency debasement and monetary collapse. You've seen the charts showing historical gold to silver ratios. You've convinced yourself that this is a sure thing. It's not. Nothing is. The purpose of holding silver is to provide insurance against specific macroeconomic scenarios and to diversify away from purely financial assets. That purpose is destroyed if you overconcentrate, to the point where a reversal in silver prices devastates your overall financial position. Think about it from a risk management perspective. If you put 50% of your wealth into silver and it falls 40%, you've just lost 20% of your total wealth. You'd need silver to rise 67% from that lower level just to get back to even. That's a mathematical hole that's extremely difficult to climb out of. Whereas if you'd allocated 10% to silver and it fell 40%, you'd have lost 4% of your total wealth. Disappointing, but manageable, and you'd have maintained optionality with the other 90% of your assets. This brings me to a related point about leverage. Some investors, seeking to maximize returns, consider buying silver through leveraged products, futures contracts, or margin accounts. Unless you're a professional trader with extensive experience in these instruments, this is almost certainly a mistake. Leverage amplifies both gains and losses. More importantly, leverage adds a timing dimension that doesn't exist with outright ownership. You can be right about direction and still lose money if your timing is off or if volatility triggers margin calls. The vast majority of retail investors who use leverage in commodities markets lose money. This isn't because commodities are bad investments. It's because leverage magnifies psychological pressure and forces decisions at the worst possible moments. If you're entering the silver market, do so with capital you can afford to hold through significant volatility, not capital you need next year, not capital you're borrowing, capital that can sit untouched for 3 to 5 years minimum. Finally, if you're considering silver mining stocks as an alternative to physical metal, understand what you're actually buying. Mining stocks are leveraged bets on the underlying commodity, but they're also exposure to operational risk, management quality, jurisdictional risk, and equity market sentiment. They can outperform physical metal dramatically in bull markets. They can also underperform dramatically when any of these other factors turn negative. Treat mining stocks as a separate asset class from physical silver, not as a substitute for it. Now, I want to be very direct about the specific mistakes I see investors making right now. These are the behaviors that consistently destroy wealth in precious metals markets. The moment you find yourself checking silver prices multiple times per day, you've lost objectivity. The moment you feel anxiety when prices drop or euphoria when prices rise, your emotions are controlling your decisions. Emotional investors buy tops and sell bottoms. They do this because they allow short-term price movement to override their long-term strategy. Don't be this person. I mentioned this earlier, but it bears repeating. Using debt to buy silver, whether through margin accounts, credit cards, or home equity lines, is gambling, not investing. You're betting that the timeline of silver's appreciation will be faster than the cost of your borrowing, and that no significant correction will occur that forces liquidation. This is an extremely low probability bet, regardless of how convinced you are about silver's long-term prospects. There's a compelling story around silver right now. Monetary debasement, industrial demand, supply constraints, ratio plays against gold. All of these narratives have elements of truth, but narrative is not the same as rigorous analysis of your specific risk-reward at current prices. Don't let a compelling story substitute for actual critical thinking about valuation, timing, and position sizing. Physical silver is not as liquid as stocks or bonds. If you need to sell quickly, you'll likely receive less than spot price, especially for smaller quantities or less common products. Don't allocate capital to silver that you might need to access on short notice. Build adequate emergency reserves in liquid assets before committing to precious metals. If your primary motivation for buying silver is that it's gone up significantly and you want to participate in those gains, you're already making a mistake. Assets that have already appreciated substantially have, by definition, less upside potential and more downside risk than assets that haven't appreciated. You're buying high and hoping to sell higher. Sometimes this works, often it doesn't. If you're committed to precious metals exposure, don't put everything into silver. Gold offers different dynamics. Platinum and palladium offer different supply-demand characteristics. Diversification within the sector reduces specific metal risk. Precious metals are often taxed as collectibles in many jurisdictions, with higher tax rates than standard capital gains. If you're holding in taxable accounts, understand the tax consequences of selling before you need to make that decision. Yes, precious metals markets have experienced manipulation historically, but building an investment thesis around the idea that manipulation will end and prices will skyrocket is speculation, not strategy. Trade and invest based on what is happening, not on what you believe should happen in a fair world. Before you allocate significant capital to silver, ask yourself, do you have adequate emergency reserves? Are you contributing to retirement accounts that offer tax advantages and employer matches? Do you have high interest debt that should be paid down? Precious metals should complement a sound financial foundation, not replace it. So where does this leave us? We're at a point in the precious metals cycle where opportunity and risk exist in equal measure. The investors who will succeed from here are not the ones who can predict what happens next. They're the ones who have clear strategies, appropriate position sizes, and emotional discipline. If you're holding silver, recognize that the easy gains may be behind us. That doesn't mean you should panic and sell everything. It means you should actively manage your position, consider taking some profits, and resist the temptation to believe the current trend will continue indefinitely. If you're considering entering, understand that you're not buying at the beginning of the move. You're buying into a market that has already attracted significant attention and capital. That doesn't make it wrong, but it does make your margin for error smaller. In either case, the principles remain the same. Allocate only what you can afford to hold through volatility. Diversify across multiple asset classes. Use systematic approaches rather than trying to time perfect entries and exits. Maintain adequate liquidity in other parts of your portfolio. Keep your position size reasonable relative to your total wealth. And perhaps, most importantly, separate your investment decisions from your beliefs about how the world should work. You might believe that fiat currencies are doomed. You might believe that silver is fundamentally undervalued. You might believe that a monetary reset is inevitable. These beliefs might even be correct. But investment success doesn't come from being right about the big picture. It comes from managing risk, maintaining discipline, and surviving long enough to benefit when your thesis eventually plays out. The investors who held gold through the 1980s and 1990s were ultimately proven right about its value. But many of them had to endure 20 years of stagnation and ridicule. The ones who survived were the ones who allocated appropriately, who didn't overextend, who maintained balance in their lives and portfolios. That's the real lesson here. Silver may go significantly higher from current levels. It may experience a sharp correction, may trade sideways for an extended period. Nobody knows with certainty. What I do know is this. The investors who approach this market with humility, discipline, and proper risk management will be fine regardless of what happens. They've positioned themselves to benefit from upside while limiting their exposure to downside. The investors who approach this market with overconfidence, emotional decision-making, and excessive concentration are setting themselves up for painful lessons. The critical warning I'm giving you today is not about price direction. It's about your behavior. It's about recognizing the psychological phase we're entering and protecting yourself from your own worst impulses. Markets don't care about your convictions. They don't care about your timeline. They don't care about how badly you need them to go a certain direction. Markets simply are. They reflect the collective decisions of millions of participants responding to changing information and shifting sentiment. Your job as an investor is not to predict or control the market. Your job is to position yourself intelligently within it, to manage your emotions, to maintain perspective, and to make decisions based on sound principles rather than hope or fear. Can you do this? That's entirely up to you. The opportunity in precious metals remains real. The risks are equally real. How you navigate between these two realities will determine your ultimate success. You've been warned, not to discourage you, but to prepare you. The question now is, what will you do with this information? Will you ignore it and continue on your current path, hoping that everything works out? Will you panic and make reactive decisions based on fear? Or will you step back, assess your position objectively, and make deliberate strategic adjustments? The choice, as always, is yours. But make it consciously, make it rationally, and make it soon. Because the window for clear-headed decision-making won't remain open indefinitely. As markets become more volatile and emotions run higher, the clarity you have today will become increasingly difficult to maintain. This is your moment. Use it wisely.